Right now, the Forex markets are a barrage of surging inflation, erratic interest rate hikes, and sudden geopolitical shocks. It is loud and it is fast. If you're trying to trade the short term, that environment is exhausting. You're glued to the screen, battling fatigue, and forced to react instantly to every minor economic headline that flashes across the wire. This chart shows the reality of the 5-minute trenches. You can have a perfect technical setup, and a single, slightly disappointing employment report completely blows up your trade. Surviving this volatility might actually depend on reacting much, much slower. This is the logic of position trading. It's a strategy where you hold trades for weeks or even months. You're not looking to scalp 10 pips off a daily blip. You're looking to capture a massive, overarching economic journey. Stepping back to filter the noise replaces high-stress reaction with a stable, strategic advantage. For a position trader, the daily charts don't matter. Your true compass is fundamental analysis, the broad economic data that dictates where a currency is actually heading over the long haul. The strongest driver of those long-term moves is central bank policy divergence, specifically the gap between the interest rates of two different countries. Take the U.S. Federal Reserve. When they commit to an aggressive, hawkish rate hiking cycle, they are actively raising interest rates to combat inflation. Contrast that with the Bank of Japan, which has historically maintained a notoriously dovish stance, keeping their interest rates pinned near zero. This diagram illustrates what happens next. Global capital predictably flows straight from the low-yield zone into the high-yield zone. Investors want the best return, which creates a steady, months-long strengthening of the US dollar against the Japanese yen. That's your macroeconomic bias. If you can't define that underlying story in a single, clear sentence, you don't have a valid position trade. Once your fundamental direction is locked in, you need to know exactly when to enter. That requires zooming out to weekly or monthly technical charts. You are looking for a moment of confluence. That's the rare setup where your fundamental catalyst aligns perfectly with a historically significant price level. Notice this solid horizontal support line, a long-term price floor where the market repeatedly bounces over several years. Now add a 200-week moving average tracking the long-term trend. It sweeps in, reinforcing that exact floor. That exact intersection is your high-probability entry target. A brilliant macroeconomic thesis needs patient execution. Waiting for that precise point of confluence ensures you enter the market on your terms and filter out the false signals. Holding a trade for months means you have to completely rewrite your rules for risk management. A traditional 30-pip stop loss is instantly destroyed by the normal, everyday volatility of the weekly market. Stop losses must be drastically widened, often to 150 or 300 pips, placed safely below a major weekly swing low for breathing room. As this stop-loss bracket expands downward, you proportionally reduce your position size, ensuring total risk never exceeds 2% of your equity. And once that stop is set based on your technical logic, never manually widen it out of fear while the trade is live. Doing so destroys the entire structure of the setup. Mastering this inverted risk profile, wider stops, smaller positions, is the only way you can endure short-term chaos long enough to capture massive macro gains. Once your trade is live and perfectly placed, you face the hardest psychological challenge of all, the absolute necessity of doing nothing. It is completely normal for your account to sit in the red for days or even weeks. Initial drawdown is just the expected cost of admission for riding major trends. Instead of frantically checking your charts every hour, you replace that exhaustion with the discipline of a simple weekly review. During that review, you only need to ask yourself two things. Has the underlying fundamental story changed, or has a critical technical level broken? If the answer is no, you let the trade run. Position trading replaces the frantic daily grind with a calm, intellectual pursuit of global economic shifts. Ready to find your macroeconomic edge? Start identifying the next major trend today by utilizing FXNX's comprehensive economic calendar and institutional-grade charting tool.